All right, we are live. Everybody, welcome to our YouTube channel. For those of you who don't know me, I am djtenhoeve. I am the CEO and owner of the Tenhoeve Realty Group at Keller Williams. We are a New Jersey residential and commercial real estate firm. And tonight, thank you for giving us your 6 o'clock hour. This should be somewhere between a 30 and 60-minute conversation, depends on how many comments and questions you guys have. But this is a conversation about Ukraine and how the invasion of Ukraine has and may affect the U.S. real estate market. So thank you for giving us your time and following this. Please make sure you drop us a like down below, subscribe to it so you can see more messages and videos like this as we drop them. Now, a couple ground rules. This is going to be a conversation between a couple industry professionals about what we have seen and where we see things going. This does not constitute legal advice. It does not constitute financial advice. So before you make stock decisions, bond decisions, selling your house, make sure you talk to a real estate agent. Make sure you talk to your legal counsel. Make sure you talk to a financial advisor. So let's talk a little bit about what this is going to be and what this is not going to be. This is intended to be a conversation talking about what's going on in the market. This is not intended to be a political conversation. So if you notice in the bottom corner of this screen, you will see a QR code to donate. We are actually doing a team effort here to try to raise some money for the UN High Commission on Refugees due to the humanitarian crisis that's happening over in Ukraine. So feel free to donate there. But this is not going to be a conversation about who's right, who's wrong, any of that. We're staying out of that. This is purely going to be a conversation about what's happening with the real estate market and how it relates to the invasion of Ukraine. So tonight, I have an esteemed colleague of mine who's going to be joining us. We had a little switcheroo. So if you saw any of the advertising about Mark Carvajal, we had a little switch up here. We have Steve Carpitella, who is the Chief Retail Officer of Equity Prime Mortgage, also one of my close buddies and friends, a surfing pal of mine, and one of the smartest dudes I know financially. So just to go back, over it again, what we've seen, Steve, is a lot of volatility, right? We'll kind of pick up with what you said has happened in the last week since Ukraine was invaded.
Yeah. So just to walk it back for a second, what everyone really needs to realize about these situations is they're termed in our world as geopolitical events. Anytime there's a bomb threat, a war, anything, doesn't matter, around the world, when there is tension between countries and things of that nature, it creates what's called a risk off trade. A risk on trade is when everybody's buying stocks and buying equities, which is the riskiest class of assets. And when you have these events occur, such as Ukraine and Russia, if bonds and stocks are competing for investing dollars. So right now you'll see stock market swings big time, 800 points down. Everyone's dumping stocks and they're buying bonds. So just like there's a demand for housing and home prices are going up, the more people buying bonds shoots bond prices higher. And there's an inverse relationship between bond price and bond yield. So interest rates are going down when there's a demand. So in short, good news is bad for rates. Bad news is good for rates. And the last 24 hours is actually a great example, or the last 72 hours, like this week, rates were down a little bit on Monday, down big time yesterday, and we erased all those gains today. Like rates are literally back to where they were. So, I read an article the other day, mortgage rates plunge. Well, you want live news? Mortgage rates spiked. That whole entire rally lasted 24 hours.
Okay, so back to a real world scenario. Sally Smith, I am under contract on a property. I'm closing in 45 to 60 days. I've already got my mortgage application in, but now I'm working with you to figure out what should I be doing. Was it worth me locking right now? Is it not worth me locking right now because it's such a volatile environment? You quoted me, a 3.5 or a 3.75 rate, and we got swings in both directions. What should we be doing right now if I'm Sally Smith?
Yeah, so some of those conversations revolve around risk tolerance. So think of it no different than your investing strategy. If you're a conservative investor, you're going to be buying, what we call smart money, which is bonds. If you're a more aggressive investor, you're going to focus more on aggressive asset classes such as stocks. And so it really comes down to that. Like, are you a gambler? Do you go to AC? Do you go to Las Vegas? Or do you do any gambling? If you're not a gambler, bird in hand. Take what you got and call it a day, especially depending on how payment sensitive you are. But what we really do is educate people about the difference in payment. A lot of people don't realize that an eighth or quarter point rate isn't going to make or break your budget. But for some people, it totally could. Like they may be already at the brink of, hey, I can't afford over X. And so first we start with that education process of what the impact of our eighth or quarter point would be to the payment. And some people, I have some clients who are total gamblers. Like they think interest, like they may be tied into the market somehow and think interest rates are going to go down. Some think they're going to go up. So I really leave it on the consumer to make that decision. I don't give any advice. I just provide the information they need to know. And how long they're looking to lock for does have an impact. The longer time you lock in for, the higher the interest rate and or fees would be. So someone locking in for 6 months, for example, like I don't think anyone needs to go take a 6-month rate lock, because we can get into that, but I don't think interest rates are going to go much higher from current levels.
Okay, so just pause there for a second. Like if you're going to walk away from the YouTube now, we don't think that rates are going to be in a rising environment in the next 6 months. Go ahead. You can pick up what you were saying.
Yeah. So it really just comes down to risk tolerance ultimately. And if you're happy with the payment, you're happy with the numbers, you should lock in bird in hand and walk away and don't look back. That's the whole point of rate lock. So the question I get often is, well, what if rates go down after I rate lock? And I go, well, what if rates went up after you lock in? And, I call you and I'm like, yo, DJ, check it out. Rates are up a little bit right now. I was wondering if maybe we can bump your rate from 3.75 to 3.875. Is that cool? I don't even know if I'll finish that sentence before you hang up on me, right? Like, or you're going to scream, hey man, I got a rate lock, and I'm going to be like, oh yeah, you do, so like, what's the point of locking a rate? And it's like almost like a sales contract, right? What's the point of having a sales contract if you decide, you know what, I decided I don't want to buy this home anymore? You can't do that.
Well, it's 2022. People are trying that too.
Yeah. Well, I think, ultimately it really comes down to how sensitive the consumer, that particular consumer is, Sally or whatever example you use there in this case, is to payment. And, there are people that are super conservative and don't even want to deal with it. There are other people that are gamblers, and there's everybody in between. So we try to provide that information. But the longer amount of time you have on, if you're 60 days out, I would say, it's not necessarily a bad idea to float. March is typically a rate friendly month, for example. The beginning of the year is always a little volatile because you have a reposition of money at the end of the year. For everybody with their portfolios, and then you have new bets being placed going into the beginning of the year. Right. So, January is historically not a rate-friendly month, as an example.
Got it. Okay. So let's talk then about what happens in that environment where rates are volatile and how that affects the real estate market too, right? So this is the other half of it. This is where DJ puts his hat on. So what we've seen with the rise in prices over the last 2 years has been caused by what I would say is 2 to 3 things happening at the same time, right? COVID happened, but what people forget is right before COVID happened, we were having the busiest first quarter of 2020? That first quarter was the busiest quarter we had seen in about 13 years. We came out of the fall of 2019 in a bit of a sluggish market real estate wise, and then the Fed, I know there's not a direct correlation between what the Fed does with rates and what happens with mortgage rates, but mortgage rates essentially dropped in the beginning of 2020, and buyers came out of the woodwork and started buying a ton. And then we hit March, and everybody panicked, and we didn't think there was going to be a real estate market, and then May took off. But we have a rate environment that's been positive, right? So it's been, your affordability, from relatively speaking, has been good. That's why a lot of people are buying. Then you had people's change of exactly what they needed out of a house happened, right? So COVID happened, you were stuck in your condo or you're stuck in your house, and your need for your house completely changed. It was no longer just a place to have parties and have family functions and lay your head at night. It became, this is my world. This is my bubble that I live in, and what I need from this is totally different. Now I need a work from home space. I need a space where my spouse can be in a different part of the house and they're working. I'm stuck in these 4 walls of 900 square feet and I've got a quarantine. I need to be further away from somebody. My dog needs a yard. My kids all of a sudden want to be out. Or I left the city. I got into a place that had a yard. I rented it for a little while. And damn, I fell in love with it. Like, my family actually got used to living in that environment. So now people started shifting where they wanted to live based upon that. So you had mortgage rates being low. You had people diving out of cities for the most part and trying to get to suburbia or urban areas, rural areas. And then on top of that, you just had the normal market, right? People who were just at a time where they had to move. They were in a rental and their rental was coming due and they had to move out, or they were in a condo and they just had twins and they needed more space. So you add those 3 things together and that caused the market to just burst. It just went nuts. A ton of demand, not enough supply. It got gobbled up very quickly. And that's the environment we've been in now for basically 20 months, where we just don't have anywhere near enough supply to meet the demand that's out there. Rates being low is still continuing that pressure on the market. And as rates, from what you're telling me, if we don't think rates are going to go up in the next 6 months or so, that's only going to cause more pressure on the demand part of that equation of supply and demand. And you're going to see, in my opinion, if that happens, if rates stay low, you're going to see the supply is going to stay low, the demand is going to stay very high, and that causes spikes in valuations to continue. Anything you hear in that I'm wrong in?
No, not at all. And and one thing to take into consideration too, which you kind of hit on in your synopsis there, is there's winner and losers in economic events, and a lot of companies thrived in in that during COVID, and that's more consumer dollars that get spent. Like the economy actually strengthened
Right.
as a result of it. So it really changed some people's lives. People are making more money and upgraded their living situations on top of that.
Yeah, absolutely. So if anyone has watched the videos we've done on quarterly market updates and what our projections were coming out of out of the third quarter of 2021 into going into the beginning of this year, we were really hoping to see over the winter and into the early spring that rates were going to rise, which happened, right? We were just talking about rates went up a full percent in less than
Full point
90 days.
in 45 days.
In
Yeah.
45 days. So that was a good thing, right? So as a buyer myself, I don't love that because it means now my affordability has changed. What I can afford and what my monthly payment is different. But as a real estate agent and as a market maker, that's hugely important to me because 20% year over year growth is not sustainable. We can't continue to do that. And the only way that I've seen that we're going to get to a place where that demand starts to shrink and get more in line with the balance of supply is if you take some buyers and put them on the bench. I can't afford the house anymore. The price has gotten too high. The payment's gotten too high. I need to pull out. And when that happens, now all of a sudden we get to a place where maybe there's an equilibrium to the number of buyers and sellers that are out there. And now somebody with a contingent purchase, meaning I have to sell my house in order to buy, can bring their house to the market. And now we hit equilibrium and there's enough supply out there as well. It doesn't sound like that's where we're headed if rates continue to stay low.
Yeah, and I know that's maybe one of the things we're going to talk about, and maybe a segue into that, just to give some insight as to what is going on and why we may have already potentially hit the high yield of the year. Not a guarantee, but we can get into talking about that as well if you want.
Yeah, go for it.
Yeah. So what and this I'm not trying to make anybody an expert on bond markets here, but DJ alluded to earlier in the conversation that what the Fed does with hiking rates and what mortgage rates do are not directly connected. A lot of people don't understand that the Fed's fund rate, the rate at which the Fed charges banks money, has been at like 0% for this entire time. So if you're a bank, you're loving it right now. You're getting free money. You just get to turn around and sell it at a higher rate. And then mortgage rates are dictated by the bond markets, mortgage-backed securities in particular. So the bond markets don't wait for the Fed to hike rates. They wait for the Fed. The Fed is giving monetary guidance and talking about what they're going to do. So the bond markets sell off ahead of Fed rate hikes. So no one wants to get left holding the bag. If the Fed's going to start, stop buying mortgage-backed securities, nobody wants to keep buying MBS when they know the Fed's no longer a buyer, right? The demand for those bonds is going down. So bond traders start selling off now. The Fed does this to not disrupt the market. They want to try and create a stable environment for bond traders. So they're giving the guidance saying, hey, we're going to stop buying mortgage-backed securities by the beginning of March. I think this week is literally the official last week that they're buying mortgage-backed securities. And that's what's putting pressure on interest rates because you have less demand. So when you have less demand, prices go down, interest rates go up. So that's what's taking place. So why people don't understand that disconnect, I'm trying to explain it. Like mortgage rates always move ahead of the Fed.
Okay. And we spoke about this a couple of months ago that maybe that deadline that they were going to stop buying doesn't actually happen, right? Maybe the deadline comes and they continue buying. Is that still a projection?
No, they actually have gotten more hawkish. So again, just give a little more bond technicals here. When the Fed talks, you hear about the Fed being hawkish. That means they're supporting higher interest rates. When they're dovish, they're supporting lower interest rates. The Fed has gone from a complete dove and supporting and remaining highly accommodative, which is the language they use, to the exact opposite, where they want to remove this monetary stimulus immediately and go the other way. And they're, just so everyone understands, they turn on the literal printing press. They literally turn on the printing press, print new dollars, and buy mortgage-backed securities with them. They were buying $120 billion a month this entire time during COVID. You can't even fathom that, right? $120 billion a month.
A lot
So
of
they
real
have trillions of dollars in bonds they're sitting on, mortgage-backed security bonds. And now they're not only just talking about stopping buying the bonds, which already is going to raise interest rates, which is what it did, but they're talking about reducing their balance sheet. They're talking about becoming a seller of mortgage-backed securities now. So they're going to increase the supply in the bond markets, potentially pushing interest rates higher. So, so you would say, hey, Steve, it doesn't make sense. You said
Yeah,
rates may have
so
peaked.
that's me. I'm saying so that everything you're saying to me right now is forecasting. We're seeing rates continue to go up.
Yeah, this is all being baked in. The Fed gave that guidance in November, gave it again in their January meeting. So the Fed would have to come out and say, "Hey, we're not going to reduce our balance sheet to really create a rate-friendly environment." But they're just reiterated it again today. Jerome Powell had a little thing on today that did a little speech today about this and said, yeah, they want to reduce their balance sheet. So, and they mentioned that they're not going to sell treasuries. So that means they're going to sell mortgage-backed securities and some other securities they're holding. So it's just hard to be a bond trader right now and want to be buying mortgage-backed securities when you have the Fed potentially becoming a seller. But what's going to change that, right? Like what is the outlook where I'm saying, hey, rates may have peaked already. Rates moved way higher, way faster than anyone expected. So the knee-jerk reaction pushed rates higher than we were even expecting rates to go. Fannie or the Federal Housing Finance Agency was predicting rates to be at 4.25% by the end of the year. They're already there. You know, the average 30-year fixed on Mortgage Bankers Association right now is 4.15 with some fees. So rates have already hit those levels, you know, almost a year ahead of schedule. And you know, those knee-jerk reactions. So now it's looking forward. Is the economy really on stable footing and going to be able to support, you know, a higher interest rate environment? And there's a lot of question about that their consumer sentiments at 10-year lows or 20-year lows or whatever it is. You know, some of the economic data has been mixed. Some of it suggests that, you know, the economy is doing okay. Some of it suggests the economy is not doing well at all. And then overall, we just got global economic issues. So the smart money, the bond traders, you know, if you look at the 10-year treasury, which is a key way to, like, the 10-year treasury for anybody is a flag. It tells you whether interest rates are going up or down. It doesn't tell you what they are, but it tells you which direction they're heading. And the 10-year treasury is still below 2%. So what are bond traders telling us? And that's what's considered smart money. Smart money saying, I don't know about this. Like, you know, the Fed's talking about hiking interest rates and doing all this stuff, but we don't know that the economy is really that, you know, kick butt where it's going to support a higher interest rate environment in the future. So that's this push pull that we're seeing right now where interest rates are all over the map.
Got it. So that also lends itself to an environment that is still, if you were able to get through the 1 point raise that we had happen in the last 45 days, like you said, that may be the peak. That may be the high yield of the year. No guarantees on that. But if you've gotten to this point and you're still a buyer, you should still be a buyer moving forward in the next 6 months, is what it sounds like, just based on rate alone, if nothing else.
Yeah, and then this is where forward guidance, like this is where working with a mortgage professional is super important. You know, so that 1 point difference in rate from 3 to 4%, the average loan size is 300,000 for anyone who wants to know, or slightly over that. It's $167 a month.
Right.
You know, it's a lot of money over 30 years. The average life of a mortgage is 32 months. Where am I going with this? A lot of people think, oh, I'm taking out a 30-year mortgage. This is the mortgage I have for the rest of my life. It's not. Newsflash. So, you know, that it's only 60 grand over 30 years, which is a lot of money, but over 30 years, that's really not a lot of money.
Right.
And if you look at your paycheck, $167 over 12 months is $2,000, account for taxes and all that stuff. You know, is it possible that depending on where you're at in your career, that you make an extra $2,500 to $3,000 in a year, which would outwage inflate that increase in rate? But, you know, so that's one thing to consider is wage inflation and how that impacts, you know, what your payment is today versus what it is tomorrow if you're making more money. And then on top of that, interest rates are cyclical. They are going to go up and they are going to go down. So what we educate clients about is the fact that anyone taking out a mortgage right now, in my professional opinion, is absolutely going to refinance it. I just don't know when, but I would say within the next 12 to 24 months. You know, the Fed potentially may hike us into an economic recession. And that is where the concern is for long-term interest rates. That's why we don't know that interest rates are going to continue to move higher.
Okay, so that was a question I had. It was about refinancing. With rates being as low as they have been for the last 2 years, I read some staggering statistic that 75% of the people who had pre-COVID loans that would have saved money by refinancing have still not refinanced in that low rate environment post-COVID.
Yeah, it's crazy, some of this, but like, you know, everyone who took out a mortgage in 17 and 18 has rates in the mid fours to as high as like 5.75, let's call it. I mean, I'll see a 6. I haven't seen one of those in a long, long time. I've been doing this for 20 years. But most people have, a lot of our clients anyway. Like I would say the stats the opposite for us. 75% of our clients have refinanced twice since doing a
Because you're doing
transaction.
your job.
Yeah, because we're doing our job, right? But a lot of people, they just don't know that they can do that, or don't have really someone that they can rely on to give them that guidance. But yeah, a lot of people, if anything, they can refinance out of mortgage insurance. I mean, think about that 20% increase you're talking about. Some people put 3.5%, 5% down on their mortgage and have mortgage insurance, and literally 6 months later are refinancing with 20% equity in their home and getting rid of mortgage insurance. It's crazy.
That is crazy.
Yeah, so a lot of people have transacted on their home, and we point this out a lot to clients like that we're dealing with now who have all this equity in their home and are pulling money to debt consolidate or do home improvements. They're giving up those ultra low rates to access the equity now. And but we're explaining to them like, hey, you started your mortgage at 5.25, you went to 4.25, you went to 3.25, you went to the 2s, and now you're back on your way up. And then we'll to grab the equity, and then we're just going to probably refinance in the next 12 to 24 months.
Right. And that also, I mean, we're talking about rates in the 2s, 3s, and 4s. With the millennial generation, we're not making judgments on millennials, right? So people talk enough crap about millennial generation. What I will say is that anybody under the age, for the most part, of 45 probably doesn't understand that in the 80s, when their parents were taking out loans, was 12, 13, 14, 15% interest rates.
I think they capped out around 18% or something like that.
People don't have a frame of reference anymore for understanding how cheap 5% interest rates are, let alone 4s and 3s and 2s.
Well, to put that in perspective for you, DJ, because I thought you'd never ask, a mortgage,
Hold on, wait. So we did not discuss this ahead of time. He's just that good.
Yeah. $300,000 mortgage at 4% is $1,432. $300,000 mortgage at 15% is $3,793. So that's $2,300 more per month.
That's unbelievable.
Just to put it in perspective for somebody.
So I have a slide that I did not show you that I'm going to bring up later in the conversation, showing affordability in the 80s compared to now, because I truly think this is the piece that people are missing. We're out here listening to people talk about how much they don't want to pay over asking price and they don't want to buy the house for X amount of money and waive inspection contingencies and all these things, which I get. But I think people have lost the frame of reference of understanding you're not buying the purchase price, you're buying the payment, and people understanding what their true affordability is now compared to what it has been historically. But we're going to table that for a second. So if you guys like that topic, hang around. Don't leave us yet. So I'm going to give another scenario. We talked about Sally Smith, who's ready to close on her house in the next 45 or 60 days. What about, I'm a flipper, right? I flip houses. I buy them as investment properties, and I'm looking to buy properties right now, albeit that's very difficult because there's not a whole lot of flip properties out there. Nothing's really inexpensive. But if I'm doing it with a loan, if I'm trying to do a carry loan on this, and I'm flipping a property within 12 to 18 months, usually faster than that, should I be worried about what's happening with Ukraine and what it's causing the volatility in the market, not just from a mortgage perspective, but are there still going to be buyers here in the next 6, 12, 18 months at the same pace that they are right now? Or should I be taking the gas pedal off a little bit and hitting the brakes on looking for investment properties? I'll answer the property side if you can answer the finance side.
Yeah, so I think, look, if you have a sound financial strategy and plan, interest rates shouldn't matter in the equation at all. If you know what you're doing and you're making, an informed decision, the rates are what the rates are. There's no such thing as a good or bad rate. There's such thing as a good or bad payment. So you just hit on that, DJ. Like, the payment is what you should be focused on. Is the property cash flow positive? Does it work for your financial situation? The rest shouldn't matter. And I think some of the hesitation, I'll just go a little sideways on you, a little of the hesitation with people looking to do things right now too is, everyone's concerned about the bubble. So I don't know if you were going to bring that up, and we could table that for later. But
No,
people
go
are
for
talking
it.
about people are talking about, is this another real estate bubble? People keep asking me about 2008. Is this 2008 all over again? No. 2008 was caused by very poor oversight, lending standards, appraisal standards. It was borderline fraud and thievery that was going on in terms of how people were being lent money. I mean, you blacked out your W-2 and just showed you had a job and you got a mortgage. That's not what's happening here. This is a real supply demand imbalance that's causing, that's driving, home price right now. So, and you could probably tell everyone better than me. What is the housing short right now? It's millions of homes. The last I heard was maybe close to 5. Is that 5 million homes short?
Yeah, it's a little over 5 million short. I mean, the simplest way for us to explain this to the general market, and it's the same statistic that I use on my own, is absorption rate, which is how many months of inventory are there on the
Yeah.
market right now. The way we think about this, and it's easy for anybody to calculate. You can look at it by trying to get data online or ask your real estate agent. Is all right. I'm looking to buy in this town. How many houses are on the market in that town right now? How many houses sold in that town last month? You divide those two into each other, and it tells you how many months would it take to sell everything that's on the market right now. A neutral market, meaning equal number of buyers and sellers, nobody really has the upper hand, is between 6 and 8 months of inventory. Over 8 months of inventory means it's a buyer's market. There's way less buyers than there are supply. So as a buyer, I command what the seller is going to do. Anything less than 6 is a seller's market. Just to give you a frame of reference, we're at 1.2 months of inventory
Yeah, it's crazy.
nationally. It's the lowest it has ever been, ever. So when you hear people say like I can't find a house, it's true. Like there's really just not that much inventory. But the thing that people are losing sight of is last year, 2021, more homes sold last year than ever in history. So although there's a lack of inventory, there are so many buyers and there are houses being sold off market that there are still more transactions, more volume happening in 2021 than have ever happened in history. But from a bubble standpoint, I'm 100% in agreement with you. It is a supply and demand pure equation. And we have way more demand than we have supply. And I don't see that stopping for a decade because of the imbalance you talked about. You said 5 million houses short. That 5 million houses short is caused by a lot of things, but the main driver of that right now is the millennial generation coming into home buying. We
Yeah.
were short. Yeah.
What was that stat? It's like there are. I'm going to butcher it, but like there are a certain amount of like I don't know. It's like half the population's turning 31 and older over the
Yes.
next like several years.
Yeah.
Like it's crazy.
And the part about that I think that people got wrong, right? So if we think back to these types of talks we were having 7 years ago, it was, oh, millennials aren't going to buy houses. They're the renting culture. They rent watches, they rent cars, they rent houses. They don't want to be stuck anywhere. People were way off, completely off. They absolutely wanted to be homeowners. They just got started later in it. They had to clear student debt and they wanted to get themselves established as professionals before they actually bought their house. But they're here now and they are not stopping, and there's nowhere near enough supply inventory to satisfy them. So just another little dorky statistic we're going to throw in here is the baby boomer generation, right? The millennials parents or half a generation ahead of them. We needed to build 1.2 million houses a year to satisfy the demand from the baby boomer generation. And starting in 2007, when the market crashed, we never built more than 900,000 houses as a
Yeah.
nation per year ever up until now. Still haven't gotten there. Now that's 900,000 houses compared to the 1.2 million per year that we needed to satisfy the baby boomer generation. And here's the shocker. The baby boomer generation is half the size of the millennial generation. So you want to talk about a housing imbalance and why we're talking about a decade-long seller's market? That is why we are in the market we're in and why it is a good time to be buying houses.
Yeah, and the only thing that would throw a monkey wrench into that, like, I know some of the questions was, should I wait to buy a given market? Maybe the market comes down and stuff like that. The only thing that's going to disrupt that supply demand imbalance is a major economic event. COVID only affected certain industries, and certain income levels, whereas everybody else just continued to work from home and figure it out and you know reinvent themselves. A real economic event comes with real job loss. And, so short of a major economic recession, now keep in mind, a recession is 2 consecutive quarters of zero to negative growth. That doesn't mean that like the world's ending. It just means that there's just no real like growth happening in the economy. So, a major economic recession is real job shrinkage. So, just gives a frame of reference, historical reference. 2008, we were losing like 300,000 jobs per month. So 300,000 people per month were no longer able to make their mortgage payments. So think about all the inventory that now got dumped onto the street, and that's why home values tanked. So short of something absolutely unforeseen, right? So we can talk about a million what ifs, and if we what if ourselves to death, we won't even walk outside the house because you're afraid you might, a rock may fall from the sky and kill you, right? Like you can't live in fear like that. Your decision shouldn't be based on some unforeseen thing. So assuming no unforeseen circumstances, such as a major economic event, yeah, this is a seller's market for as far as you can see.
Okay, but is Ukraine that event, right? That's the question. That's why people are here tonight. They're wondering, is Ukraine
Yeah,
going to be that?
World War III, is that, is that where
Right.
things go? Like, yeah, I mean, that would put a pause on just about everything, right? Life's on pause if things escalate and go there, and that's something that should be monitored. And again, not to get into political debate, I just like to think that we're, as a species on this planet, we've evolved past that point of having to go there anymore, and hopefully things don't get to that point. But it's anybody's guess.
Yeah, I don't think there's enough data out there right now pointing towards World War III being a reality. And look, I might be looking back and eating crow on this one, but at this point, March 2nd, 2022, if you're trying to make a decision on what's in front of you right now, the scales are in your favor of that not happening. And provided that that is not the monkey wrench that causes a financial implosion of the entire economy, the world economy, this is a geopolitical event that's happening internationally, but it doesn't necessarily drive your decision on making a real estate related decision here in the United States.
Yeah, like
If
we
you
still need to live our lives,
right,
So
still
that's
need to make your decision. I mean, one of the answers we gave to somebody this past weekend was, what are you buying the house for? Is this an investment property? Is this a vacation property? Is this a place where you're trying to move your family for the foreseeable future for the next 10 to 12 years? That should be what's guiding your decision on whether this is the right thing to do right now. And if you're going to be moving your family here for the next 12, 15, 20 years, this blip, even if it ends up being, let's say, worst case scenario, right? We go and replicate what happened in the 2007 financial crisis, and we retrace 20% on the market, which, by the way, 20% is less than what we went up in the last 2 years due to COVID. But let's say that happens. You're riding this out for a 10 to 12 year plus cycle that
yeah, they
doesn't
don't care.
change. It doesn't change what you're doing.
Exactly. And this is I use the analogy of stocks, like, do you sit there and look at your stocks every day and decide whether, like, if you're looking at your stocks every single day and deciding whether you should sell or not, you probably shouldn't be a stock investor unless you're a day trader. Like, you're making a long-term investment in a company, and you should just buy it and never look at it and see what it's worth, down the road, depending on what your investment strategies are. But the bottom line is, if you're not selling your house, then you don't really care what it's worth. Like, I don't plan on moving. I really don't care what my house is worth on any given day. I don't even think about
Because it's not actually worth that right now. Unless you're a
it.
seller in the market, it's not worth anything because you're not transacting.
Yeah,
Right.
exactly. And this is the advice we're giving to people right now who are looking to potentially tap into some of that equity. Well, should I? And it's like, well, just like your 401k or any other investment, like, it's there today, could be gone tomorrow. So if you have a need, grab it now. Well, what if I end up underwater and the market tanks and now I don't have any equity in my home? Who cares? If you're not selling, you shouldn't care. Just like you've watched your 401k. I mean, look what happened to people's 401ks during COVID when COVID first hit.
Right.
Every asset class dropped by like 50%
Right.
initially for like a day or two. Like, things got nuts, right? So you're like, oh man, I had 50,000 in my 401k, now I got 25,000. And then it came back. So home values go up, they go down, and
Right.
they go back up.
So this is not to say that we're not going to feel some pain in the short term, right? So inflation is crazy high already, right? We're in a world where everything is more expensive. Cars are more expensive. Bread is more expensive. Milk is more
Everything.
expensive. Building more materials. Everything is more expensive. And it's going to get a little bit more painful, especially given what's going on with Russia, right? So Russia is the second largest producer of petroleum. And although the United States does not use a tremendous amount of that, it's going to cause heating prices for your house to go up. It's going to cause gas prices at the pump to go up. And other plastic products, right, that are made from oil are going to go up as well. So there is going to be some more inflationary pressure coming, right, Steve?
Yes and no. Yes on the oil for right now because of those issues, but there are ways for the oil reserves of the world to mitigate that. They can change policy. They can crank up production to offset these issues. So that can be controlled to some point. So really, the gas pump would probably be the hardest place hit. But keep in mind, the inflation issues are transitory. Like most of the supply chain issues, think about it like, what, China was shut down for, I don't know, 6 months. And then we had a year of stuff going on here, call it an 18-month, blackout period that has to cycle through everything. That 18-month blackout period is going to end this year. So the Fed's already talking about, they think inflation is going to subside this year. And today, actually, Jerome Powell came out and said they don't think they're going to do more than a 25 basis point rate hike. And the market, rates actually went up on that news because the Fed's not fighting inflation. You fight inflation by raising interest rates. And now the Fed's not going to raise interest rates as much as they were expecting because they're expecting inflation to actually subside. So inflation is expected to come down this year.
I think that's a welcome sign for a lot of people. They would love to hear that because of just the cost of everything that's gone up. That ties into the kind of the bonus we talked about, something I was going to throw up on the screen that I hadn't shown you yet, and I want you to kind of break it down with me. So give me 1 second here. All right. So on the screen here, I don't know if you can see this. Can you see it, Steve?
No.
Okay. So
I've seen this chart, what you're referring to.
This is going to be really fun for you to try to break down when you can't even see it in front of you. So what this actually slide was taken from Keller Williams' vision speech. We were just at our big conference down in Orlando last week, and this came up from our chief economist of the company, which actually goes through what was the cost of a car on average in 1999 versus 2021, what was gas price, what was house price, mortgage and purchase price, and what were wages. And then if you adjust for inflation, what does that look like compared to where we are right now? So because you can't see this, I'm actually just going to run through this and explain it, and then I'll ask you a question. So car right now, average price of a car is $46,404. In 1989, it was $15,350. If you account for inflation, you adjust that $15,350 for inflation over what's happened since 1989. We are 30% above in a car price where we should be just based on inflation. Gas price, $3.51. In 1989, it was 97 cents. You guys remember that when you used to be able to go and actually get a gallon of gas for $1? And adjusted for inflation, that 0.97 cents should be $2.25, which is we're 56% above where that should be. Now, when you look at a house, and I just dragged it off the screen here, the price of a house in 1989 was $94,000. Adjusted for inflation, it should be $218,000, but we're at $346,900. We're 58% above where that would be normally. But the mortgage is the part that hasn't changed in the same. Like all of these are above, right? Except if we look at what a mortgage was, it was $825 back in 1989 for that $94,000 house. Now it's $1,455. So that is a decrease of 24.5% on your mortgage related to inflation, related to what it was back in 1989. So I just butchered that whole explanation, but I want you to explain what that means from an affordability standpoint based on where we are historically.
Yeah, I mean, it just comes back down to, what is inflation, right? The increased cost of goods or services over time. So I'll use my hand chart here, but as cost of things go up, has wage inflation gone up along with it? And that's one of the challenges that we're seeing, is that wage inflation was dormant for a decade. So while things have gone up in cost, I remember like my parents, grandparents, they used to get like a 5% raise every year just for having a job another year. Like everybody, you just made more money if you worked there longer. That isn't necessarily the case anymore, right? Like, teachers' contracts, all kinds of stuff where they got to fight and unions have to go on strike to try to fight for more money. So when the cost of everything is going up and the it's a consumer-based economy, right? 70% of economic activity is consumer-based, meaning we, in short, economics 101, we buy and sell goods and services from each other. That's what makes the world go round. So when you have the cost of things increasing over time and the money that we make not increasing in connection with that, it's not lockstep, then it creates these imbalances in cash flow and dries up consumer money. So from an affordability standpoint, yes, life is very expensive right now, more so than it should be, in a nutshell.
Got it. But at the same time, what your mortgage is as a percentage of what money you're making is historically cheaper now than it was in the 80s.
Correct, because interest rates are historically low. So when we look at, so this is where we confuse people, right? So we're just talking about inflation, the cost of everything's up. Yeah, but the cost of money isn't.
Correct.
If you actually look at a 30-year bond chart, if we had a bond chart to throw up, literally a 30-year bond chart goes like this, and it looks like it's heading to zero. And we're probably going to get there at some point. Germany did. Germany has negative interest rates. Imagine paying a country to hold your money. They were doing that in Germany. It's now positive, the German 10-year bond. But yeah, we are on a path to potentially zero interest rates if that chart holds up. Will we ever bounce and go back the other way? So where is this all? What does this all mean? So as life has costed more, and as wage inflation maybe hasn't gone lockstep with inflation, and everything's more expensive on the outside, how does the Fed stimulate the economy? Interest rate policy, monetary policy. So this is why interest rates have come down for over 30 years. So how do you help the consumer reduce their biggest monthly nut? How do you do that? Keep interest rates low. So even while we're talking about interest rates being at 4%, it is historically low. When I show people bond charts, I'm just like, these are still historically low rates. But again, to the millennial, it's like, these rates are high. Like, no, they're really not. These are super low interest rates. You're just accustomed in the last 10 years since 2008 to these rates in the three, really it's been 3.25 was the record low rate in 12 and 16. And again, in 19, or beginning of 2020, we reached 3.25 again. And then the dip below 3.25, the first time it ever happened was because of COVID and the Fed buying so much mortgage-backed securities to drive, money as cheap as possible to stimulate economic activity. So to DJ's point, yes, homeownership affordability is actually the cheapest ever.
Right, but like you just made the frame of reference for a millennial who says rates are really expensive because their frame of reference is narrow, right? They're used to seeing 2.5 to 4% interest rates, and this feels expensive. That's also what people are looking at in the real estate market and going, well, damn, this is like crazy. These houses are expensive. They just went up 20% in the last 18 to 24 months. I can't buy this price. I got to wait for it to come down. And I think that's where people are completely wrong. They're basing that logic on the most recent history that they have, which was a completely and fundamentally different real estate market and an economic market back in 2007 from where we are now. If you are betting on this being a bubble and that you being able to buy a house next year for less than you're buying it for right now, you're going to be sitting on the sidelines and you're going to be regretting that decision in 12 more months. Just like you're sitting here regretting that you didn't buy last year or the year before that.
Yeah. And I've had those conversations with many clients, who I was like, my advice to clients, and maybe yours is similar, necessity is the mother of invention. If you need to own a home, then you're a home buyer right now.
Right.
If you need to own a home, you're a home buyer. If you're kicking tires, you're in the wrong market. You're either all in or you're all out. That's basically like, you're just not going to find that deal right now. So you're either all in or all out. And if you're going to be all in, be prepared to pay ask or higher or give up certain contingencies.
Got it. So I know this sounds like the mortgage guy's trying to talk you into taking a mortgage. The real estate guy's trying to talk you into buying a house, that we're always going to give you that advice. That's not always the case. There are times that are good times to buy and bad times to buy based on economics. And if the forecast, like if you say you're gonna be in and out of a house in the next 3 years, 4 years, and it looks like that market's gonna dip, we'll give you the advice that maybe that's not the right way to do it. That's not what we're talking about right now. The market, foreseeable into the future, is going to be increasing because of a housing demand, a supply shortage, a demand increase. And if you want to be waiting here, not being able to buy, the best thing you could do is not buy right now. If you want to be sitting in a house for appreciation, whether it's 2 to 4%, which is historically normal, or if it's another 7, 10, 15% over the next couple of years, you have to get into the market right now. And you have to stop paying attention to what the asking price or the 10 or 15% you're paying over the asking price is, and start paying attention to where it is historically affordability-wise and where we are. Basically, what percentage of your income are you spending, because you're buying the payment, like we were saying, you're not buying the purchase price.
Yeah, and how expensive is rent right now? I mean, inflation in rent too. I mean, like, I think a lot of people are running the numbers and seeing that, like, the payment's about the same or sometimes lower than, renting a house.
Not only that, but you can't find those either. I mean, the imbalance of what happened during COVID, right? So when purchases are way up, usually rental options are down. Like, people don't want to rent when it's a good time to buy, and inverse. So when people really want to rent, they don't typically want to buy because of the rate environment or decreasing home prices or whatever it is. COVID completely shifted that. Now all of a sudden you have no rentals available, no homes available to buy, and people want to do both and they can't find either inventory. So that drives the rental prices up at the same time. So you're spending more to rent and your money's sitting on the sideline and not appreciating in the market right now.
Yeah, and what further made that happen, we didn't touch base on this point, and just a quick point to make is, COVID was technically an economic event, but there was no economic fallout from it. the CARES Act protected homeowners and tenants. Gave forbearances, deferred mortgage payments, moratoriums on evictions. So there was there's minimal foreclosure activity coming out of this economic event. Typically, millions of homes should have hit the market. We wouldn't be in the supply demand imbalance if that were to happen. I mean, obviously, we're glad it didn't, but like that just further, extrapolates the issue here, or exacerbates the issue in terms of this real supply demand imbalance.
You just brought up a good point there. I think there's some questions out there about this, which is, oh, right, we forgot about all those people who couldn't pay their mortgages and are going to get foreclosed on now that that's all been lifted, and they can actually get, landlords who evicted their tenants and now can't afford to keep the places, so they're going to end up getting foreclosed on, or people who got foreclosed on. I mean, I know the data that I've seen. That is not coming. Is it out there? Yeah. Yes, there is inventory coming for that, but it is not what you guys are thinking, that there's this entire off-market opportunity of inventory of foreclosed properties. Most of those forbearances were corrected and people got back into payment because they were reemployed within a couple of months.
Yeah, I got bad news for everybody. The CARES Act encouraged lenders to do whatever it takes to limit that damage. So the forbearance is turned into deferred mortgage payments. Some like say you didn't make your mortgage payments for a year, you got $30,000 in mortgage payments. They're literally just tacking that on as a separate lien on the property, and it'll get paid back if you ever refi or sell. So they're not making everybody come. A true forbearance is a timeout. Hey, I can't pay you right now, but in 6 months I'll pay you everything that I didn't pay you, and you get back to current. Most of those have been, lenders were incentivized through CARES Act to be accommodative, and they have the CFPB and everybody, all the watchdogs looking at them like, do the right thing here for America, the homeowner, everything. And you're not going to see the fallout. It's not coming. Minimal.
Bad news for all of our investors who buy things at foreclosure auction. It'll be there, but and we'll get back to where we were, right? So foreclosure auctions and sheriff's auctions that were going on with short sales or foreclosure properties, they'll be back, but it's not going to be this overhang of inventory.
Yeah, there's no shadow inventory. There's not a massive shadow inventory out there coming onto market.
Exactly.
And yeah, they created a 40-year mortgage-backed security for government loans, Ginnie Mae. So a lot of the homeowners who would are perceived to be lesser credit, less that's not really the case with a government loan, just FYI, but like that is the image it has. They're lesser credit, not good as credit, or higher debt to income ratios. People that were most likely to default, they stretched their debt out to 40 years. So, like when I say they're being accommodative and making it happen and making it work, they are literally keeping people in homes through being extremely accommodative. So there is a 40-year mortgage that exists, not to the person trying to buy a home. That may be coming at some point, as affordability can be a challenge for certain income levels with everything going up. But it's not there today. But they did reclass all those mortgages into 40-year mortgage-backed securities.
Wow. Yeah. Well, we're at 7:00. I don't have any additional questions that come in. It looks like we've actually answered what people have. I'm sure there will be additional comments that come up afterwards as this actually gets put up on our YouTube page. But I just want to thank you, Steve, for being on here. And thanks for giving us an hour and giving me an education, as always, on mortgages and what's going on. I think the message you guys are hearing both from me and from Steve is obviously every scenario is unique, but generally speaking, if you think that Ukraine and the invasion of what's happening there and any economic fallout that's happening from that, if you think that that's going to change the real estate market in your local market here in the United States in the near term, meaning the next 12 months, it's not likely going to change that. And if you're a buyer now because of fundamentals, you should still be buying. And like Steve said, the rate is the rate. You just deal with what's happening, but we are in an environment that they should be dropping in the next 6 months, and we'll see what happens.
Yeah.
Anything else? Absolutely. Thanks for being on. Anything else you wanted to leave everybody with?
No, I think we covered a broad-based amount of topics here and gave people hopefully some information to help them make decisions.
Absolutely. Well, thanks for being on. I appreciate it, guys. Our Instagram, or my Instagram, is at djtenhoeve. Steve's is not on here, but you can check out Mike Carvajal and he can drive you back to the EPM site. If you have any further questions about this stuff, please feel free to reach out to us through our YouTube page, our social media pages. Shoot me an email, give me a call. We appreciate you guys being on here, and we'll see you next time.
All right. Thanks.
See ya.